Thursday, February 8th, 2018, Monaco 64, home of alternative economics and contrarian views. So this morning I want to look at the bigger picture. I'm going to look at the US dollar, the 10-year yield or interest rates. I'm going to look at the Dow. I'm going to look at the commodities and why I think the PPT or the plunge protection team this time will be unable to stem the tide that is turning completely. It's basically receding. The era of easy money, in my opinion, is going to be finished. And I think we're just at the turn, and that's why we're seeing so much volatility. That's why I don't think the plunge protection team, which is composed of the U.S. Treasury, the regulators like CFTC, SEC, the Federal Reserve, those people, the president, the Exchange Stabilization Fund, which is run by the U.S. Treasury Secretary and the president, I don't think they'll be able to do anything to stem the tide because the market is much bigger than they are. I know the Fed's printed $4 trillion or even more in the last 10 years or so, but capital markets are like $300 trillion plus. You know, the Fed's balance sheet is minuscule compared to the market, and I don't think markets are like nature. They go in cycles, and I don't think they're going to be able to stop it. Before I go further, I like to talk about Jim Sinclair's the 5 golden pillars. Jim Sinclair has been in the markets for over 50 years. He traded the gold markets in the 70s and early 80s, made a fortune from it. He's got his own blog, JS Mindset, if you like to go to. But he's always said that you need 5 things to see a bull market in gold. And one is a recognized top in the US dollar, which I think we have seen. The other pillar is trust in US paper assets declining, which I definitely think is happening now. The other one there, it says bullish general commodity markets. And that's the one that I think right now we don't have yet. But I think we'll get it. I don't think we can go much lower, and I'll show you why. Triple deficits of U.S. budget, current account, and trade firmly in place. Well, that pillar is definitely there. That pillar will never be broken, I think, it's really solid. And I'm not saying that's a good thing, of course. And a recognized top in U.S. Treasury long bond. Well, I think that's in place as well. Or a recognized bottom in the yield of the long bond. Long bond for him used to be the 30-year, but this drawing is from a few years ago. I would say more it's the 10-year. The 10-year is now the benchmark. The 30-year bond used to be the benchmark. So recognized top in the U.S. Treasury, 10-year note, I would say, would suffice. So let's look at the dollar then, the recognized top in the dollar. So here we have the chart. We've seen that the 50-week moving average is well below now the 100-day moving average. That's the black line is the 50-week. The orange line is the 100-week. We now just need to break the 200-week, the both lower period moving averages need to cross through the green moving average. So we're only starting actually in the bear market in the dollar. We haven't even gone through the 200-week moving average. Ideally what you want to see in the bear market is that the 200-week is higher than the 100 and the 100 is higher than the 50. What we're seeing now, of course, is a little bit of consolidation there, as you can see in the dollar. Nothing drops or rises how can I say, in one go. There, nothing goes. There are consolidations, and that's what we're seeing right now, just a consolidation. So I think the beginning of 2017 there, that is the recognized top in the US dollar at 103.82, and that's of course in terms of the dollar index. It's a nice top in the 10-year note or the recognized bottom in yields. Well, let's look at the 10-year note first. Here you've got a chart from 2011. The top was there in 2012, around 136. We had another top in July of 2016, which was, in terms of the yield, that yield was lower than the yield in 2012, and the reason the price hasn't gone higher is because of the way futures trade and the basis between the cash and the futures. But so yeah, the top I would say is 2016, because that was when the 10-year yield bottomed as well. So let's say it's at 134 there, and you can see there that the moving averages now, that the 100 week is just moved below the 200 week. So that is a really, really bearish signal. And the 50 week is already way below the 100 and the 200. I'll zoom in here. You can see we're just the 100 week has just gone below the 200 week. So that's definitely, in my opinion, a top in treasuries. Like any other market, we're going to see corrections and consolidations. But from now on, I think every rally, short-term or medium-term rally in treasuries will be taken as an opportunity to sell. So that's the top in the 10-year note, recognized top, in my opinion. Recognized bottom here in the yields, July 2016, was roughly just above 1.3%. And as you can see, this is why I'm saying the tide is turning. Look at this trend line that we've had since the 80s and how we've broken through it now. And I don't think there's any way to stop it for any, the people at the Fed, the Treasury, or other central banks. They're not going to be able to stop this. This is, the tide is turning. The markets are going to show who's boss. Since the Greenspan came to power in the late 80s, they've been able to do this, but now the tide is turning, as you can see. 3% in of itself, some people say it's not an important level. I heard Larry Fink of the BlackRock saying it doesn't matter if treasuries are at 3% or more, but technically it signals that the trend, the tide is turned, that we're not going to see lower highs and lower lows in yield. So if we're very close to that. We're around 285 right now, 282. So not far from 3%. So this is the recognized bottom in the yield. So now the Dow, the stock market. I just brought a chart here, weekly chart from January 2012 to now, and I think this is a top in the stock market. Am I saying we can't go back to just below 26,000? No, we could very well go back, but this is like 2007 when we made a top. It might take a little while for this top, for this market to consolidate. It might just crash all at once, probably won't. So yeah, I think this is a recognized top in the stock market. So now to the commodities. So first I want to show you a chart here comparing the commodities to the S&P. And this was, I think this was middle of 2017. Don't have a more recent chart, but we're not that far away from that green circle that I've got, that KC Research put there in 2017. So you can see how undervalued commodities are. And a lot of people think, oh, if yields are going to go higher, if the stock market is going to, come off, if the dollar is coming off, we're going to have a recession and commodities don't do well in recession. Well, let me give you the bad news. They can, and that's what stagflation is called. This is what we had in the 70s. We had high unemployment, low stock prices, high commodity prices, high yields, a weak dollar. So I think we're just preparing to go back to the stagflationary scenario we had. I don't think, you look at the CRB index now. The CRB index, that's at 190 right now, and that's where it was roughly in 1980. So we were at 192, and in the early 80s, we were at 200 or 190. So can you really tell me that with all the inflation we've seen, all the debt that's been created, that commodities and real things should be worth the same they were 38 years ago? I don't think so. There's going to have to be a total reset, and that's what the reset is going to be. The market's going to do it. So that's the big picture. So what do we do in this scenario? Well, I think it's up to the individual, but those people who hold physical assets, especially the monetary assets like gold and silver, we need to be patient. People who hold stocks for trading, I think they need to be careful. Am I saying, owning companies and businesses is always a good thing, of course, but what is the value of it going to be? I don't know. So to finish off, I just think we are in a very historic moment. We're turning, the tide of easy money we had since the 80s is finished, and that's why we're seeing things starting to rumble. The 1,850 point drop last Friday and Monday this week in total in the stock market. The treasury yields spiking higher. The dollar, melting down, even though it's stabilized right now. Those are all signals of things to come, in my opinion. And I don't think King Canute or the PPT will be able to stop it. I mean, the Soviets tried to centrally plan their society, and that didn't last forever, as we know, when the Soviet Union just imploded peacefully, I guess. There's no bloodshed, but the system just imploded overnight in the late 80s, early 90s. That's it for now. If you enjoyed this video, please like, share it, subscribe to my channel if you haven't yet. You can also follow me on steemit.com and on Twitter. And with YouTube censoring a lot of videos, I still make ad revenues from the videos, but not as much as I should. So if you like to help and donate to my channel, there's some links below in the description. Take care, and I'll talk to you later. Bye.